Today, we'll talk about challenges in forecasting. Before we dive in, a quick note. This content is for educational purposes and is not affiliated with, sponsored by, or endorsed by the CFA Institute. Imagine you're trying to bake a world-class sourdough bread using your grandmother's legendary recipe. You follow every step, but the bread tastes like cardboard. Why? Well, it turns out the flour you bought was actually sawdust. Your oven hasn't been calibrated since 1994, and you are using a thermometer that measures in Celsius while the recipe is in Fahrenheit. In the world of the CFA Level 3, we call this mess challenges in capital market expectations. Today, we are breaking down why the data we use to forecast the futures is often as messy as that sawdust sourdough. We are looking at the pitfalls of economic data, measurement errors, and the ghosts of historical regimes. First is the data trap, lags, and revisions. When you are building a forecast, you're only as good as your data. But economic data has a lag problem. Lag is just a fancy way of saying the delay between when something happens and when we actually get the report. Some data comes out in a week, but for developing economies, you might be looking at 2-year-old numbers. It's like trying to drive a car while looking only at the rear view mirror from 5 miles ago. Then come the revisions. Governments love to go back and change last month's final numbers. Let's talk about the mental model. The rebasing illusions. So we visualize an index like the Consumer Price Index or CPI. CPI measures the change in prices for a basket of goods. Sometimes agencies rebase this index. Think of it like a reset button. If the index was at 140, they might suddenly declare today's value is 100 to make the math prettier. If you accidentally mix the old 140 scale data with the new 100 scale data, your forecast is going to look like a mountain range that just fell off a cliff. Always check your base years before you crunch those numbers. The midpoint GPS checks for us so far. We've covered how slow data reporting, constant government revisions, and changing index scales can make your starting point totally unreliable. Now, let's look at the hidden errors that live inside the data itself. Number 1 is bias, and number 2 is smoothing. So there are 2 big biases you need to watch for. First is the survivorship bias. This happens when a database only includes the winners that survived until today. If you study hedge fund returns and ignore the 50% that went bust and disappeared, your average return is going to look way better than reality. Second is appraisal data or smoothing. This is huge for real estate or private equity. Seeing these assets don't trade every day on an exchange. We rely on appraisals. Appraisers don't change their minds every hour like the stock market does. Here's the math directions. Because appraisal values change slowly, the measured volatility goes down. When volatility goes down in the math, the correlations with other assets also look smaller than they actually are. It makes the asset look safer and more diversified than it truly is. Now, we have a level 3 secret for you. It's called regime changes. If you get an essay question asking you to justify why historical data might be useless, you must mention non-stationary. Non-stationary means the statistical rules of the game have changed. We call these regimes. Think of the US bond market. We had a high inflation regime in the 70s, a falling interest rate regime for 30 years, and a zero interest rate regime after 2008. If you use a 50 years average for bond returns, you are mixing three different worlds. On the exam, if they asked if you should use the whole data set, you ask yourself the following: has there been a fundamental regime change? If the answer is yes, and the data proves it, you should only use the recent relevant part of the time series. You are doing the heavy lifting now, so you don't have to do it in the exam room. If you want more of these audio deep dives to turn your commute into a study sessions, subscribe to Study Buddy. Until next time, bye for now.